All right, everyone. Welcome to our special webinar tonight. This is a very special webinar called The Market Outlook and Advancing the Straddle. I'm Tom Gentile, and with me today is Mike Wade. I'm going to be bringing Mike into the program here in a few minutes. I want to talk about our market outlook first and give you an idea where we believe this market is likely to head and what is more than likely a much better indicator to follow in the markets as we move along. We're going to discuss the overall markets, but the big thing that we want to cover tonight is we want to help you dive in to what less than 1% of traders are looking at. And what I mean by that is when you take a lot of the traders out there was a lot of fear and greed that have been revolving around this market the last couple of weeks. And, although the bump to the upside, it looks like it's coming in a little bit late, and I do think this volatility is going to continue. We look more towards the long term. I'll show you what I believe is going to happen. But we're most interested tonight in looking at Q3 earnings. And really because we have what I believe is an incredible way to make the safest amount of money in the least amount of time, predictably and consistently. So we're going to do that as Mike shows us. We're going to go through some basics of a straddle, not very much at all, and then we're going to show you kind of the new type of strategies and the new patterns that we've come across. It's something I like to call behavioral dynamic response patterns, and these are patterns that are based on fear and greed. We're going to show you how we spot them. We're going to show you how we profit from these patterns, and we're going to talk about something that I believe is dramatically unlike your current trading strategy, even if you trade non-directional, because you're going to see something completely different, something that's outside the box. So before I go any farther, I got to do two things. First, we need to cover quickly the disclaimer. And so let me move to our disclaimer. And, I'm going to leave this up on the screen for just a few moments. You can stop this when you get the recording. We are recording this session, and we are taking questions throughout this session. If you have questions, you can put them in the Q&A box, and we will ask as many as we can. I got to tell you guys, we have a full house tonight. I mean, huge number of people in this room. So we won't be able to get to everybody's questions, and I do apologize in advance if we don't get to your question tonight. Couple things about this disclaimer that I want to hit on. Number one, stock and options trading have large potential rewards, but also large potential risk. You must be aware of these risks and willing to accept them in order to invest in the stock and options markets. Realize that what we're going to cover tonight we do a lot of back testing here, guys. We're what we call RBT traders. So those of you that are brand new, RBT stands for rules-based trading. All right. In order to create rules, we also go back and we test those rules against quantifiable data. All right. So knowing that, I want you to keep in mind that a lot of our stuff, we get some great historical patterns, but they're based on history. All right. They're based on the benefit of hindsight. And so, no representation is made that just because it worked so great going in the past, that it's going to continue to work that well in the future. But that's how we trade. All right. The other thing I want to mention is that myself, Mike, Jay, and everybody else associated with Tom's Trading Room, LLC, are your educators. We're here for educational and information, okay, and informational purposes. And keep that in mind. You need an options account in order to trade options. And keep in mind that there are brokers and companies out there that will do that for you. We are not a broker-dealer. All right. Everything I'm going to mention tonight is in U.S. dollars unless noted otherwise. So next thing I want to talk about with you real quick before I get into Q3 is I want you to do the following. All right. This is important. First thing I want you to do is make sure you're somewhere where you don't have any distractions because you're not going to want to miss any of this. Number two, take notes. I find it, when I used to sit in the room as a student and I was listening to a speaker and they had something that was worth my time, I was writing it down because if I was writing it down, I was committing it to memory. And then number three, have an open mind because some of the stuff we're going to show you is not going to make sense, especially if you have a lot of experience trading options because we've got some new groundbreaking technology we want to show you and groundbreaking knowledge on the subject of non-directional trading. And that's going to be coming up in just a few minutes. So let's go ahead and begin. I want to talk about market outlook, and we're going to get into Q3 in just a moment. But I wrote an article which I sent out to everybody that's in this room called the 3 C's of risk. And the 3 C's of risk are basically China. I see China as one of the C's of risk. It's the biggest C, all right? Commodities and currencies. Now, we're going to cover that in just a moment. I also want to go take a peek into the money calendar, which is our latest patent pending technology in terms of looking backwards for 10 years and getting an idea based on individual stock seasonality, not only what individual stock patterns there are going forward, but an idea on the most widely held stocks and the most widely traded stocks going into or coming out of a cluster. So we'll talk about that. And then we're also going to look at what we call darknet channels. And darknet channels, that's our contrarian signaling strategy. And so what we do is we use that. It's very similar to Elliott Wave. It just doesn't have the cost that an Elliott Wave software does. All right, so we're going to look at 3 different things: overall markets, seasonality, and contrarian, all within the next few minutes. So let's go ahead and do that. I'm going to move over to my stock charts. And so the first chart we're looking at here right now, this symbol is FXI. All right, this is something I haven't shown to anybody in the past. We actually do have the ability to get FXI right here in our tools, but you can pretty much pull this up anywhere. So this is a chart of the iShares FTSE China Index. All right, so if you want to follow China, this is one way of doing that. And so you can see what's happened here when you look at the FXI, that back in May, which is also the time that crude oil topped out, all right, we started to see that moving where we were getting lower highs, lower lows, all the way down. We had a big push down in July, and then we had another push down around the end of August, just a few weeks ago. You can also see that by the red line that you see, which is moving higher and higher. This is the implied volatility of the at-the-money options, all right, an average of the at-the-money implied volatility between 7 and 30 days. And you can see how it spiked here in July when we had that the couple of days of drawdown, and then it spiked again even higher just a couple weeks ago when we had that huge rush to get out of these stocks. And so that fear factor went to a new high, highs we haven't seen in years. All right. So where are we at right now? Well, yesterday we came very close to touching the bottom that we saw, just 2 weeks ago, when we had that huge rush down and we saw that 1,000-point down day just a couple weeks ago in the Dow. Well, we came down and it really looked like there were a lot of traders that went short on this thing on the weekend, and they got their head handed to them because within the blink of an eye, China was up, and we saw a move from this index, which went from the low 30s, all right, to the mid 30s within one trading day. Now, yesterday we had a holiday here in the U.S., so some of that happened yesterday and some of that happened today, and we're just seeing it as a one day move. All right, but the one thing that's interesting is volatility got real high a couple weeks ago. And even though yesterday we had gotten very, very close to the yearly lows on the China FTSE ETF, volatility had already been down quite a bit. So a lot of the fear was out of the market. And so apparently between that and some of the things that happened over the weekend, we saw a push to the upside. Okay, this is great. Now I want to take you to our neck of the woods. All right, for those of you that live in the U.S. and trade the U.S. stocks, we're going to equate this over into a couple of areas. Number one, SPY. All right, so this is the equivalent of the stock market, the spiders. And again, you can see what happened with SPY. We had we had a triangle pattern that was going on, and we busted out of that triangle big time just a couple weeks ago. We found some footing down here around the 188 area, and we moved back up into the range of looks like about 200. We fell off of 200, but today we actually closed up near our highs of the day at 197.46. I would really like to see a close above 200 before I really felt like we were going to be moving back towards that 200-day moving average, which we busted out of a couple weeks ago to the downside. That's also going to be a resistance area too. So you got two resistance areas in the SPY, and that's 200, which is a round number resistance, and then you've got the 200-day moving average, which is sitting right now, let's call it 207. All right. Another area that I want to look at. Oh, but let me mention this: volatility has fallen off, even more so here than it has in China, and so we are falling back down. We're actually, where we were at a high of 43 on the 7 to 30 day options. Now we're down, we're down in the low 20s. So we've really cut off nearly half of the time premium that was in options surrounding SPY in just the last couple weeks. Next area I want to go to is I want to go to TLT. So TLT is the iShares bonds. And so, it's the equivalent of buying, in this case, 20-year Treasury bonds. But we look at it as a mix between the 10 and the 30, the 10-year notes, the 30-year bonds. And you can see here, too, that on the day we had that 1,000-point move in the Dow, the bond market jumped up. We saw this huge flight to safety. And that was up here around the 128, 129 area. Where are we at today? We're coming down and we're hitting new fresh lows over the last week. We closed at the area of 120.87, and volatility actually, interestingly enough, spiked up a little bit. And so, volatility usually spikes up when we get a huge jump in the markets, and we did see that a couple weeks ago, but it is dropping lower. This is the equivalent of bonds. So as this moves lower, we expect to see interest rates to pick up. This is going to be really good for stocks like insurance stocks and financials, which had a great day today, especially financial stocks that benefit from an increase in interest rates. All right. So that being said, let's move to the next of those areas. And remember, I talked about the risks in the market being China, and we're not out of the woods yet on that one. The bond market is kind of our idea of where the fear factor is, and it looks like fear is starting to come out of the markets, especially looking at the TLT moving lower. The next area we want to look at is commodities, and so I'm going to go to USO for that, that's really, I think, the best industrial commodity we can look at, which is oil. And so crude oil, if you remember back just a couple weeks ago, we hit a new low in USO, which we came down below 13. We were in the 12s. Then we had a couple of days where we had this huge spike up, and right now we're settling out around 15. In fact, the close today was 15.02. What's happened with volatility? Well, volatility is interesting because the huge moves in crude oil, volatility tends to go up when crude goes up, and it goes down when we level off. All right, so we've leveled off right now, which is why you saw volatility go from above 60 to around 50 right now. All right, it is starting to poke its head back up again because if oil continues to drop down, that it was our sign that we had some problems with emerging markets, and it could be our future sign that we're not out of the woods yet in emerging markets. So I like to look at China, number one, FXI. I like to look at USO, worldwide. Where's USO? Believe it or not, cheap oil is good for the consumer. It gives them kind of an instant tax break. It's not so good for the economy because it tells us our economy is actually worldwide is actually lessening. All right. And then the third thing we want to look at is currencies. And the currency that I look at right now there are two of them I'm very interested in. Number one is FXE. All right. That is the currency that we look at, which is the euro dollar. All right. As that moves up, that's actually typically good. All right. When it moves down, it's typically telling us that our US dollar is moving higher, and therefore not only are stocks and shares now worth less, but goods and services and currencies overseas are also worth less. Now, there are, other than FXE, FXE is probably the most widely traded commodity or currency. But you know what I've been keeping my eye on lately is I've been keeping my eye on Canada, Australia, and New Zealand. All right. So New Zealand's just, it's one of those currencies that's not as widely traded. But if you look at Australia, in a sense, you're really looking at New Zealand as well, because those two commodities correlate real well. Why am I interested in what's going on with Canada, Australia, and New Zealand? They're all natural resource countries. All right. Look at FXC. FXC is FX Canada. All right, the currency shares for Canada, and you can see what's happened with the Canadian dollar. It has moved from the low 80s down into the mid 70s in just the last couple months. All right, FXA is the Australian dollar. Currency shares Australian dollar. And you can see here, we moved from the low 80s down to below 70 not too long ago. In fact, the disparity between Canada and Australia and New Zealand is actually I've talked to a couple of very smart traders here in the last couple of days that are currency traders, and they're saying something's wrong. These are out of whack. So expect a huge jump once the dust settles, not only in the Aussie dollar, but also in the New Zealand dollar, because they seem to be spreading apart more so versus the Canadian dollar than they have in the past. But those are the risks, all right. And if you read that email I sent out with that publication the article I wrote called the 3 C's of risk, you'll understand a little bit more about why I look at these and the tipping points that could happen. All right. And also take a look at FXA. Even though we popped up again today, volatility is still high. All right. It's still high. And that's important to keep an eye on, because that's telling us that maybe we're not out of the woods yet down under. All right. Now, let's go ahead and move to a couple of other things. So, darknet. So, darknet is one of these things that we look at when we're trying to get an idea or a read on what contrarians are looking at right now. So, I'm going to change this to just the highest, most liquid options that are out there. And so, you look at CINA, British Petroleum, all right, Qualcomm, and Procter & Gamble. And these are right now, these are particular stocks that are getting what we call channel collisions. All right, these are contrarian signals, and you can see here that we have particular options we're looking at. But I got to tell you, Procter & Gamble and Qualcomm offer some of the best slippage on these options. All right, because their spreads are very, very thin. So if you believe that Procter & Gamble, PG, or Qualcomm are likely to rebound from where they are now, then it's possible that, like we said, we've got a potential darknet channel. And look here, I'm looking at Procter & Gamble. So here's its past: buy, sell, buy it again, sell at the top, buy, and then had a rebuy down here. Now we're actually getting a third signal as it's starting to move higher. All right, let's take a look at Qualcomm. So Qualcomm, and I can go back in the past and I can see exactly what these have done. And so we've got some buys and rebuys and sells, and right now we're getting buys and rebuys once again. Again, what makes these particular signals come into play? Very simple. It's when we're looking at channel collisions from long-term, intermediate terms, and or short-term channels that are colliding and telling us that there's a change on the horizon for those stocks, a contrarian signal. So we're seeing, and if you look at these, you can see that you've got Procter & Gamble, Qualcomm, you got British Petroleum, CINA, a little technology in here, all right, a little energy in here, and of course the cyclical, which is Procter & Gamble. Are these the ones that are going to be the beginning of the turn? Next thing I want to take a look at is let's come on over to the money calendar. So the money calendar, and I'm not going to get into this too deeply, but the money calendar is also part of our tool set. And what we do here is this is the month of September. And as you can see here, we've got the month of September, which is it's interesting because the first week we were looking at, and this week we see decisive bullishness going on. Now, after the 15th, it starts to turn orange and red, which means that the majority of our patterns that we're seeing, and these are patterns on individual stocks. So we take a look at the top 250 stocks. We can get exact buy and sell dates on these stocks for bullish and bearish opportunities that, with over 10 years of data, have performed historically to 90% or better on the win-loss ratio. So, for instance, tomorrow is the 9th. Tomorrow I've got 49 bullish signals, and I've got 7 bearish signals, so we're clearly tilted into the bullish camp. As we go into Thursday, it goes to 86%. As we hit Friday, 81%. Monday, 84%. Then it starts to turn, it almost looks like fall leaves. We're turning a little yellow, a little orange, a little brown, a little red. And so it's telling us that, guess what? We could see another potential pullback. Guys, this is all based on 10 to 20 years of data. And so we can go in and look at individual stocks, and we can get everything from their past patterns to to their projected future, their exact entry date, the exact exit date, and the average move that we can get in those particular stocks. I just wanted to show you the overall calendar as we're going into the rest of September. And so I say that because September is one of the toughest markets or the toughest months to trade. A lot of people say October is, but October is typically the first week or two of October, and then things start turning green again. All right, meaning that we see a lot of seasonal bullishness that happens toward the mid to the end of October. But as we hit middle of September, mid-September to mid-October, typically the toughest period of the year to trade based on the seasonality of individual stocks that are the most widely traded stocks. So that being said, let's talk a little bit about advancing the straddle. And so, like I said, with me tonight is Mike Wade. He's one of the best straddle traders that I know, and we've spent years and years together, not only trading straddles and not only teaching, but more importantly, in the last couple of years, more recently, what Mike has done is Mike has put together, starting with a number 2 pencil and a legal pad, he started seeing patterns on certain stocks, and then he added that to that stock chain. And what we've done is between then and now, we now know within a shadow of a doubt the best time to buy a straddle and the best time to sell a straddle on particular individual stocks. All right, so we're going to talk about what 99% of straddle traders look at, what the 1%er looks at, which are what we call event-driven straddles, and we'll talk about risks, and we'll talk about what others don't know, and we're also going to talk about problems and solutions. So at this point, I want to bring on Mike Wade. Mike, welcome.
Hey, Tom. Good to be here.
Glad to have you, buddy.
There, I learned quite a bit. Yeah, it's always a pleasure. We've been teaching together since 2002, and option trading has made a profound difference in my life. And I think even what has made a bigger difference in my life is giving it to others. So I started off as a credit trader. I like to sell options. I actually started out, Tom, as you probably know, I took the course from the cab driver, and I learned how to sell naked puts, and that worked in '98 and 2000, at least the first part of 2000, and then I really got a mouthful in the balance of the year in 2000. So I've been teaching and trading this stuff for a long time, and I've always had my eye on straddles. But the thing about straddles I noticed is that they didn't always work. So the way straddles are taught is a straddle is you buy a call and you buy a put, and if the stock price moves, you make money. And some people apply straddles before an earnings announcement as a catalyst for a price move, but they don't work all the time. So I wanted to take a look at it, and I've only recently become a straddle trader when I really started to take a closer look at how straddles actually tick. So a straddle is non-directional by nature, but actually carries quite a bit of risk that 99% of people don't know exists. So a straddle is buying a call in case the stock goes up, and it's buying a put in case the stock drops. Here's an example of a straddle on Apple. This straddle is we're buying a 125 call, and we're buying a 125 put. And the total cost for the straddle is $10 per share controlled. So we're looking at a $1,000 straddle. And the risk graph is really quite attractive, right? So, the profit is on the right side of the risk graph where the vertical line is. And as long as the stock moves one way or the other, then everything's great. Now, that's true, except as time passes and as implied volatility fluctuates, the entire risk graph starts to change. So one of the reasons that straddles, there's a few reasons why straddles. Let's go to the next slide, Tom. I can actually break down using what is it about a straddle that needs to be mitigated? What are the risks of a straddle that you really need to understand in order to trade them effectively? In fact, if you understand exactly how a straddle loses money, and then you also understand how a straddle makes money, then you can position a straddle appropriately to maximize your profit and dramatically, I'm going to say dramatically increase your probability of making money with these things. And that's one of the reasons I love, I love this topic and this strategy is that if you do them right, if you know that 1% of the stuff that most people don't know, then position these straddles and make money very often, and make a nice amount of money. And then when you're wrong, only lose a little bit. That's my favorite part, Tom. Is I love when we teach strategies, particularly to the new or the novice trader, or maybe even advanced trader for that matter, where the strategy itself, when you're wrong, you only lose a little bit. And as a teacher, as someone who's out to make an impact on people's lives, that to me is the number one thing about what we're going to cover here tonight.
So, Mike, so what we're looking at here is once again, so for those that are new to straddles, which I can't imagine anybody here is, but let's just say, just in case, you're buying in this case, we're buying a near money call and put, same strike price, same expiration. We're paying for both the call and the put simultaneously. In the example we see here, this 10-point straddle is going to cost $1,000. So our worst risk is, the worst place we could be is at expiration and having that stock right at the money at expiration, because that's where the money's lost. That's your non-directional risk, isn't that right?
That's correct. Yeah, time value is the biggest aspect of risk in a straddle. Is that, as you wait for the stock to move, your theta risk shown here on the slide. The theta risk measures your position sensitivity to the passage of time. So when you buy an option, immediately time starts to work against you. When you buy a call and a put, you're doubling the amount of options you buy. Your theta risk is magnified. It's doubled, in fact.
And I got to imagine
theta risk is real.
Yeah, I got to imagine, right? The market outlook that I did, volatility as a whole is dropping. So Vega risk is really out there for a lot of stocks, but not every one of them, right?
Yeah, not every one of them. If we start to look for stocks that have an event maybe in the near future where the demand for the options will increase, even in a high volatility market, which we're in now, of course, options that are expensive can get even more expensive into a particular announcement. So the question here is there a way to temporarily turn the option Greeks on your side? So we have delta, which measures your position sensitivity to price movement. We've got theta, which measures the sensitivity to time decay, and that's a big one for straddles. And then we have the idea of this thing called Vega, which measures the demand for the option. So as demand for the options increases, that makes you money. And when demand decreases, it loses you money. So the idea here is to turn all these Greeks, align all the Greeks such that you have maximum chance of making money. So I'd like to say temporarily turn the option Greeks, all of them, on your side with a single event. And the answer is yes, you can. You can do that. And if you, and one event, the only one event I know about, Tom, unless you know of any others, is the earnings announcement. So that is an event that creates demand for options, and it also creates oftentimes movement in the actual stock price. So what's shown here is what we call an implied volatility graph. And what does this graph measure? Really what it measures is the demand for the options, which ultimately parlays into how expensive the options are. So at each of these spikes, this is I got to say, Tom, this is one of my favorite patterns. I love these red wave IV spikes. So what's happening here is these spikes are happening as a result of option traders coming in and buying options in anticipation of an earnings announcement. So at the top of each of these spikes, you'll see that there's a triangle with an E in them, and that's the earnings announcement. So if I was to pull up, this happens to be Green Mountain Coffee, but if I was to put a chart of Green Mountain Coffee up, you'd see that at each of these earnings announcements, typically Green Mountain Coffee will gap either up or down, although not consistently one way or the other. So what option traders tend to do is they buy calls and puts, and they pay a premium the day of earnings, and then they count on the stock gapping. Now, the problem here, Tom, is look what happens to the red line, the IV spike, the very next day. After earnings is announced, the demand for the option plummets. that's a risk. And what happens to your straddle in that case? Unless the stock gaps enough, what happens is the value of your straddle diminishes significantly with what we call IV crush. Demand drops the next day. The news is out. The stock does what it does, and the demand for the options plummets. And that has everything to do with the value of your call and your put, aka straddle.
So, Mike,
so that's a risk.
Let me just back up here. So there are really three types of straddle traders out there. The dumbest ones are the ones that are buying that straddle right before the earnings comes out without any type of, just because they think it's going somewhere, but they don't know if it's going up or down. Now I back up a second. This is the person who lost money simply thinking the stock was going to rise, and they just decided to buy a call option. Then they realized that didn't work. They thought, wait a second, let me do the non-directional thing. I'll buy a straddle right before the earnings report comes out. And every once in a while, they might get right. They might get it right. Of course, a broken clock's right twice a day too, isn't it? But the rest of the time it's wrong. And I consider that the broken clock strategy. It's going to work once in a while, but most of the time you're going to give that money back in the form of time decay as it drops. Now, then there's that second group of traders which say, you know what, I'm going to buy the straddle that has 60 to 90 days to expiration. I'm going to ride this green line. But they're really doing it more for a longer-term move in the stock. They're looking for more of a longer-term breakout. And the problem is they, too, after a certain amount of time, have time going against them. And then there's that 1%er who has studied this line on every individual stock and knows, on an average, the best time to get in and the best time to get out, because what they're doing is they're looking at Vega outpacing Theta. They're looking at the implied volatility coming in and the demand for these options coming in faster than the time value is coming out. Is that right?
That's exactly right. That's well said. I'd say one way to think about these things is to ride the red wave. So we're putting on trades that profit with the increase in demand up into the earnings announcement. And we put on a trade like a straddle that has no directional risk. So while we're waiting for IV to rush, if the stock happens to move, great, but it doesn't even have to move because IV will actually make us money in the options. Now, the trick, as you pointed out, Tom, is that while you're waiting for the IV to continue to rush into earnings, you're typically in this particular system, you're in a 30-day option, and time decay is going to be working against you. So the idea, as you so well pointed out, is to have Vega, which impacts your position's increase in value based on IV rush, offset or outweigh or kick Theta's butt. So as you're sitting in the straddle, time decay is working against you while you're waiting for IV to rush in. So, and this is a great slide because this talks about how earnings affect a stock price, the actual price of the stock, but also, and I'd say most importantly for the strategy, it impacts, although stock price movement is also important, the way the strategy works is that with the IV rushing, the demand increases, your options get more expensive. That's called IV rush. As that's happening, it's offsetting time decay. And it's also, while you're waiting for the earnings announcement, in the event the stock actually starts to move, you're also profiting on a stock price movement. So in this market, Tom, with the volatility that we're experiencing, while you're waiting for the earnings announcement, there's a good chance that your particular stock will also move in price. So you'll be making money on stock price movement, and you'll be making money on implied volatility rush. So
Gotcha.
the question becomes then, it's very, elegant. I almost said sexy. It is sexy. It's like really looking at the Greeks in the three primary ways that an option value is impacted, and getting really smart about it. So is there a way to look for companies that have stocks that move and then have an effect on the option pricing? And of course, with Tom's tools, the answer is yes. There's something called the earnings effects ranker, And the earnings effects ranker can go out and find stocks that either gap at earnings or the implied volatility rushes at earnings or crashes after earnings. Here's a chart of Priceline, a fairly recent chart, and you can see that the earnings announcement is shown there with the green E on the top of the chart. You can see that the stock price actually moved into the earnings announcement. It didn't really move that much in this particular case after the earnings announcement.
Right, and
take a look at the next chart.
And let's make sure we let everyone know that the E there is the actual earnings announcement itself, not some sort of projection. Although a lot of times they give you forward-looking information, which also even more impacts that earnings date because of their conference call that they're doing. So, Mike, what's this going to tell us?
Exactly. Well, this is going to tell us what tends to happen with the stock at an earnings announcement. I happen to know that Priceline actually, on balance, actually moves more than it did in this particular case. But what we can see is if we want to take a look at the demand for the options. And so this is an implied volatility chart. And you can see the green triangles with the E in them. And you can see in this particular case that the red line, which measures the short-term implied volatility. Hey, Tom, that's another thing that the 99% of option traders do is they buy 30-day options.
Exactly.
And you can see that reflected right here in the chart. And that's not a bad thing or a good thing, but there's consequences. And one of them is time decay.
Right.
So this IV chart is showing you the implied volatility.
I just lost the screen, but it's back.
Okay, there we go. Got it. Of the 7 to 30-day options. So the red line is showing you the implied volatility rush, the demand. Where's the demand live? It lives in 30-day options.
Right.
And you can see it very clearly here that the spike up in demand or the expense of the options, the IV rush happens into the earnings announcement, and then after the announcement, it crashes. So the idea is to get in and get out at exactly the right time. And that's the rub, of course.
And this is what we want to show you is that, we want to show you that there's a couple ways we can do this. We have the ability with a lot of data that we have. And Mike and I are really just kind of tipping the iceberg here for you. But, we like to go in and look at how earnings affect a stock like a Priceline. We'll look at the price change before and after earnings. And then we'll also look at the IV change before and after earnings. And all we're really showing you right here is confirmation that it's much easier to predict IV than it is price. So, for instance, you look at this before and after price, and this is Priceline. So what we've done is we've collected data on Priceline, and we know that Priceline moves about 2% roughly before the stock, 2% on the stock price itself before earnings, and almost 4% after earnings. What we can't tell you is predictably if it goes up or down, all right, on a regular basis. However, look at the volatility. Before earnings, volatility moves up around, an average of 15%. After earnings, volatility gets kicked down nearly 31%. So we see a rush in, like Mike said, before the earnings report, and a rush out after earnings report. And the interesting thing is, and Mike, you can confirm this, but Priceline isn't the best stock that we've found that typically rushes in and out, is it?
No, it isn't. Not at all. There are plenty of other ones, and we'll sort of give you a few to play with that are coming up in September. But I just want to back up one quick. I want to make one quick point here, Tom. The number one risk in straddles, if you can go back to the last slide, you'll see that on the IV rush, the IV rushed up 15% into the earnings announcement, and then the very next day dropped over 30%. That's something that 99% of straddle traders don't know. And that's really dangerous. You've got to be really smart about not taking on that IV crush. Unless the stock gap's very big, that IV crush is going to eat your lunch and you're going to lose money. So what do we do with this information? Well, first off, it'd be really great if we could run a scan, and we can, Earnings Specs Ranker, find stocks that have an IV rush into an earnings date, and then couple that with the earnings information to come up with great straddle. So the idea here is that we'll place a straddle, and we'll buy the straddle as the options become more expensive, If the stock moves, that's great. We'll make even more money. And that IV should offset any kind of theta decay. And that is a formula, Tom, for really awesome straddles that 99% of people don't trade. So typically, there's a lot on this slide, but on the bottom of this screen, you can see that with today being on the left side and then earnings is coming up and then expiration of the options, typically what people do is they'll buy a straddle, a 60-day straddle before the earnings date, and then they'll get out after the earnings and be in the trade for somewhere around 30 days. So typically what people will do is trade the gap, trade the anticipated gap. Now, if there isn't a gap or the gap isn't big enough, then time decay, which is measured by theta, and volatility crush, which is measured by vega, oftentimes will result in a loss. So on the top of the screen here, what we're seeing is let's get smart. Let's get really smart here, and let's buy a straddle as the implied volatility begins to rush up into an earnings announcement. And let's sell the straddle on the earnings date before the news is out. So get in and get out before the announcement. So what we're going to be able to capture in this way is IV rush and any potential stock price movement that happens from the time we get in to the time we get out. So Tom, this is not traditional. This isn't how most people trade straddles.
No, it's not. You're right. The typical straddle trader will do one of two things. They're either buying a 60 to 90-day straddle and hoping it moves outside of that point within those 60 to 90 days, maybe not even knowing there's an earnings report coming. And then there's that other more emotional trader that doesn't know which way the market is likely to move after earnings, and they think, oh, I'm going to put a straddle on because it'll move one way or the other. And then they're wondering why they lost money even when the stock moved a lot. So you're right.
Exactly. Right. So the trick is actually knowing exactly when to get in the sweet spot to catch the IV rise and profit on the IV rushing in and offsetting any time decay or theta decay. Now, the point that's really important is that this is different with every stock. So the ideal entry point is different for every single stock. So then there's the getting in, and then there's the getting out. So knowing exactly when to exit. You might decide to adjust, delta neutralize a straddle. You might choose to reverse the position and turn it into another type of strategy. And you might even, quite frankly, you might even choose to hold the straddle over the earnings announcement if historically that's a good idea. So this, what I'm going to teach you here is how to identify the best stocks and the ideal entry time and the ideal exit time. So here's a case study on UPS. And on the top of the screen, you can see that we have a particular straddle that's been identified. But one of the things that's really awesome about this screen is notice how, notice how the number of wins over the last 4 earning periods is 4. And the number of losses is 0. But what's happened here is this is a back test that's been done for me. And this is saying that if you happen to get into the last 4 straddles on UPS 10 days before the earnings announcement, and notice how we have the entry date and the exit date shown in the screen on the screen here. If you're in these straddles and you enter 10-day trading days before the earnings announcement, you can expect there to be some results similar to the last 4. So again, history is no guarantee of future success, but you can see here that we've had over the last year, there's been a 43% gain on the far right of the screen there, Tom. One that was 177% gain, and one that was 12, and one was 76. So these case studies were presented to me, and it's showing me the impact of trading UPS if I get in at a certain time, in this case 10 days, it's been identified for me, and then out by the earnings date. These are the results that have happened in history, and of course,
and Mike,
history is our guide for future success.
Yeah, Mike, and let's point out that this is based on your rules and the amount of back testing you did. by hand. Before we were able to utilize the computer to do this. And also, I want to mention that this last screen right here, based on the rules that Mike uses for entry and exit, it gave us an output. That output, 10 days later, took a $291 straddle. This is for the call and the put. And then ended up making a 49%. It had a 49% return 10 days later. So that was UPS. And we got tons of these. Here's one. Let's see. This was one looking at Amgen. And now this one's different because what you identified here, Mike, was a 2-day pattern with Amgen. So this was only, getting in and then getting out 2 days later. Same situation. There wasn't a lot of, 9%, 12 and 7/8, 43%, 78%. And then this one ended up, now this is crazy. The one you thought wasn't going to do that much 2 days later ended up with a 97% return. And that's because at the time, this was before earnings, but more importantly, what happened was there was a lot going on in biogenetics and the biotech industry. So that even helped push this thing higher than it should have gone in terms of IV.
Exactly.
So why don't you talk about the case studies you've got for everyone for today?
Yeah, these are 3 I'm looking at that have had a 100% success rate over the last 4 earning periods, using 5 days before entry. And I've got a bit more analysis to do. 5 days works, but there's actually there's likely to be a better entry. Maybe it's 6 or 7 or 8 or 4. But I want to do a bit more testing or analysis to determine the exact entry date. But anyway, in this case, 5 entry. If you get into these straddles historically, 5 days before entry, 5 days before the earnings announcement, they've all worked over the last year. So you can see here we have the buy before date, the actual buy date. So for Cintas, we have September the 17th, and get out on the earnings announcement, which is the 24th. So here what you have is the exact entry date and the exact exit date. And if history repeats itself, all 3 of these will be winners if history repeats itself. So Adobe is a really great IV rusher, moves big at earnings. Carnival Cruise Lines. I didn't actually know Carnival was a big mover until I did my analysis, but this one actually announces before market opens on the 22nd, so you get out on the evening of the 21st. So here you go. There's three case studies to have a bit of a play with before the earnings announcements in late February. September.
Yeah, no, what I'm looking at, Mike, is that as I go across here, Carnival actually has the greatest average return on investment based on its 100% historical rank. However, Adobe has the least amount of slippage when you look at the spread between the bid and the offer on both the calls and the puts. So, each one of these offers something unique about them. The one thing that they all had in common, because I got a question, what's the best one, or why these 3, is because they all had 100% win ratios in the past using Mike's criteria for finding these IV rush straddles. So at this point, I think, Mike, let's open it up. Let's see if there's any questions that anybody might have at this point. And so let's see what we got here. If you have a question you want to ask Mike, shoot it in the Q&A box here. We'll take just a couple minutes, and then we're going to continue on. So here's one. Is it better to trade earnings using an iron condor than a straddle? Which is the best strategy or strategies? Thanks. And before you answer that, Mike, there is a time to trade iron condors. I don't think buying into straddles is the right area. Selling out of the earnings report makes more sense. But we're going to show there are a couple things that you can do, and I'm going to talk about them a little bit later. But there are synthetic straddle strategies that could be used that could greatly reduce the cost if it happens to be a Google or a Priceline or something that comes up that's very expensive. And Mike, anything you want to add on that?
Yeah, I'll just say I completely get the attractiveness of selling expensive options, but options aren't expensive for no reason, right? So the options are expensive I mean, imagine putting on an iron condor right on the earnings announcement. You're selling these very expensive options. You might make a little bit if you make the iron condor wide, but then there's the there's the potential price gap. So for me, my personality is to go for, be aggressive. But one of the things that's really awesome about this strategy is it's very, very safe.
All right,
you're just not going to get hurt.
Does it work with strangles? I'm getting that question a lot.
Yeah, that's a common question. Strangles and straddles are the same thing. It does work with straddles. The only difference between a straddle and a strangle, they're both a call and a put, is the only difference is that the strike price for the call and the strike price for the put are separated. They're not the same strike price, but the risk graph is the same. They work exactly the same. So yeah, 6 of one, half a dozen of another.
Okay, and then Mike's asking if we can briefly go over how to search for these case studies ourselves with Tom's tools or others. You can do a lot of the manual labor yourself using the earnings effects and the earnings ranking buttons within Tom's tools, and you can they're fairly easily found. In fact, let me just show you where to find those. But for what you're looking at right here, this is Mike's scan. This is Mike's personal scan. It's actually not available in the general tool set, but I'm going to talk about how you can get more of this with Mike and even have this exact tool. But for the folks that want to just get into earnings and such, let me just show you what you need to do. So pop on over if you're at Tom's Tools, and what you would do is you would come over to stocks, and you want to go to stock rankers. And if you come down to the bottom, you'll see what's called earnings rankings. That's one way of looking at a more simplified version, which stocks have earnings above and below their estimates, and then which ones are coming up to or which ones have passed earnings days. The other one I want to take you to is the analysis button. Go down to stock analysis, and come on down to earnings effects. All right, and this is the area where you can go in and you can run a stock list, and you can look at what stocks had the best price change after 4 earnings, which ones had the best price change before or after 4 earnings, which ones had the best price changes before or after their implied volatility change between earnings. So that's a way you could do that as well. And we'll talk a little bit more about this button in just a few minutes. Let's see. Haven't the big swings in major market indexes been a great opportunity for using the straddle? What do you think, Mike?
Absolutely, yeah. But the trick again is knowing when to get in and when to get out, right?
I think so. I think, you know what?
Yeah.
I do think a lot of people got into some straddles a couple weeks ago and saw a huge return and had no clue as to why it happened. And so the problem is that, a lot of the novices that might have made money in the last 2 weeks probably doubled down and are in it right now, and they're seeing their winnings dry up as volatility starts to come back to norm.
Exactly.
All right,
this whole idea of IV crush after the earnings announcement is exacerbated because options are so expensive anyway that the IV crush is magnified. So you got to be really careful holding over a straddle over the earnings announcement.
Right. I'm going to ask 2 more questions and then I want to move on. So, do straddles have high risk?
It depends on the price of the stock, but if you're looking at a price line, we got into price line, for example, for less than $500. Some of the larger price stocks are you'll have to spend maybe $2,000-$3,000. So the cost of entry can be and it'll be higher even still if you go to higher price stocks. But the great news is that although you might be spending $3,000 or maybe as little as $300 on a straddle, you're really not putting that at risk, provided that you follow the rules.
All right.
Of exiting.
And then the last one is one that I can answer, and you're happy to add to it, and that is, have you tested more than a few trades per symbol? I got to tell you, Ron, we have tested the stocks in the S&P 500 over years of data. What we've learned is that when we cycle through the last 4 patterns, we get a really good idea on changes that happen. So, for instance, maybe Priceline.com 5 days in, or forget Priceline for a minute. Was it one of our stock symbols up here that you see right now? Adobe. Okay, so maybe 5 days works for Adobe, but what's going to happen is that we will see more of a pattern where maybe the low comes in a day earlier, maybe the high goes out a day earlier. These time periods between getting in and getting out will flex back and forth. My question to you guys: who has learned something so far tonight? All right, who's now learned something about straddles that maybe they didn't know about until then? All right, that's the number one thing we want to do is get you some education and get you an idea on how we trade these straddles. So let's do a quick little rewind. All right, we're not buying 60 to 90-day straddles and holding them for an extended amount of time. We're not buying on the actual day of earnings, expecting a big pop. In fact, we actually do quite the opposite. Any of my partners that are in here, and I got several of them in here, will tell you that we're selling right before that earnings announcement. We are selling premium, all right, selling it safely, I might add. But there is a big piece that a lot of traders are missing when it comes to getting in as that volatility rises up. Now, it doesn't happen with every stock, and it doesn't happen the same with each quarter with the stocks that are out there. All right, so keep that in mind, and also keep an eye on what you see down here: 15%, 11%, 20%. These are examples of stocks that popped up today. We have seen stocks that have a much greater return on investment, and it's not the Cintas, it's not the Adobe, it's not Carnival Cruise Line. It could be other stocks, and these are stocks that are likely to pop up